Welcome, everyone. Our next speaker, Alec, is lead research scientist at Kensho. He holds a PhD in physics. He also teaches at financial engineering programs at NYU, School of Engineering, and Stevens Institute of Engineering, using his book Financial Markets and Trading, an Introduction to Market Microstructure and Trading Strategy. Welcome, Alec.
Thank you. So the effects of macroeconomic developments, it's actually a topic that was studied by economists since the mid-80s of the last century. And basically the idea behind this direction is that macroeconomic developments are undiversified risk. And hence, they merit excess return. And that's how economists talk. They merit excess returns. But the theory, and the Ross, who was the author of the suggestion, he also is the author of arbitrage pricing theory that is widely used by active asset managers. The theory doesn't determine which economic events or variables are responsible for excess returns. And so there is a gallery of influential works that studied the effects of macroeconomic events, basically contrasting bond and equity markets. So that what was found mostly was that inflationary parameters mostly affect bond markets, and the growth parameters affect more equity markets. And then there was a paper appeared quite recently in 2013 by Sarah and Wilson that demonstrated that excess returns of various US equity indexes do exist. And I've seen also two other reports with the same conclusion that are not public for various reasons. So it was in the air at the time when I started looking into this problem. And the results that were published by Sauer and Wilson, they were based on data prior to 2009. And for practitioner, what this means, when the economists say that there are excess returns and they study daily returns, this simply means that if you buy on close the day before announcement and sell on close on the day announcement, you make money. Regardless what announcements are, I mean what surprises happen, which actually is fascinating and not easy to explain. It may be explained by some speculation. I return to this topic a little bit later, but let me first tell you about the framework of the work that we've done trying to test these results for more recent data, namely starting with 2009 and through summer of 2013. This paper actually is published, literally it was published a month ago or so in Journal of Forecasting, and the abstract can be found on ssrn.com. So what we did is that we've chosen 18 major macroeconomic indicators, and those indicators were described as a major before. We just borrowed this classification from previous work. And we looked at several equity ETFs that are economically sensitive. We looked at the SP 500, we looked at financial sector SPDR, industrial select, and consumer discretionary. And we described the effects of announcement using autoregressive model that includes both announcement events factors using dummy variables and announcement surprise factors. So the dummy variable is a thing that economists and statisticians use to describe event, the very event. So for example, you can describe the day of the week. Say Friday, dummy variable means that on Friday this variable equal 1, and on all other weekdays it's 0. And by the same token we can describe, say, seasonal effects and the effect of the events that happen on one particular day of the month or of the year and so on. And following all economies that work in this field, we also described the effects of macroeconomic announcements using surprises. I will show you a rigorous definition of surprise a little bit later, but in a nutshell, surprise means that economists actually try to predict what kind of macroeconomic announcement will be in near future. For example, what kind of GDP we will have, what kind of unemployment we will have. So there is a consensus that is based on polling, Bloomberg does it, of several dozen economists, and expectation is actually public information, and then surprise is the difference between this expectation and real numbers that will be published at one particular day. Now, why do we use actually surprises? For those who never thought about it, it's rooted in the belief by many economists in efficient market hypothesis, according to which the expected information is already wired in the price. And so current price before announcement does reflect expectations. And obviously if reality doesn't coincide with expectations, it's a shock, informational shock that will be reflected in changing price. So in this slide you will see, I don't know, maybe you won't see, but at least what I can say is that on this slide you will see it's listed as a major 18 macroeconomic announcements that we used in our model. And it's non-farm payroll, retail sales, industrial production. I can go down to the list, factory orders, international trade balance, and so on. So these are 18 factors that we studied. We included in our model so-called Garch volatility term. This slide shows that there is clustering on volatility during this 4-year period, and that's why we have to take care of this clustering by special terms included in our auto-regression model. And here is the model. I don't want to describe it in all details, but in a nutshell, it describes auto-regression terms that simply describe dynamics of price, and also there are terms that describe events, both dummy variables that are 0 at any other day than the days of given announcement, and equal 1 on the days of announcement. And there are also incorporated surprises in this model. So surprises, you can see here, is simply a difference between announcement values of given indicator and expected values that can be found also in public domain. And we scale them by their volatility, by their dispersion, so that we can compare, apples to apples, because various indicators obviously have different dimensions. These values could be found in several sources. They can be found in public domain. If you have patience to go through the last 4 or several years through Yahoo, for example, or CNBC, but there are companies that compile this data, so if you don't want to bother with searching the web on your own, you simply buy them. And our source was Haver Analytics at that time. So what we found is that among all these 18 macroeconomic announcements, only several had high statistical significance. It's primarily ISM manufacturing index, non-farm payrolls, international trade balance, index of leading indicators, housing starts, jobless class. And to a lesser extent, factory orders, new home sales, GDP, retail sales, which probably are not very important. So, since we found that the excess returns during this time period, since 2009 through summer 2013, did exist, we tried to compile some data for several trading strategies that we implemented in our model. So we compared the strategies that active strategy related to a macroeconomic announcement with buy and hold strategy. And then we chose three strategies. First, we calculated realized daily returns on all of all 18 macroeconomic indicators, and we call it model 18. And then we calculate realized returns on day of announcement of those indicators whose regression coefficients have statistical significance with p-value less than 0.5. This is standard for economists to trust statistical results if their p-values are so low. And finally, another model was with p-value less than 0.25. And I often get the questions why such a relaxed condition we have chosen. Not, for example, p-value less than 10%. The problem is that if you choose the model with p-value less than 10%, it will be exactly the same as 5%. So the p-value are somewhat clustered. If you want to have a really discernible model, we had to relax it to p-value less than 0.25. And if we go back for a moment to all these indicators, you can see that the first model, P5, with p-value less than 5%, contained only 1, 2, 3, 4, or just 4 indicators. And the model P25, it contained 8 indicators. And now about results. So we compare, these are results for SP500. So buy and hold, for this time period, it had 1153 days, trading days. Model with 18 parameters had 766 days when we were in the market, according to all this announcement. And you can see that model P5 had just 214 days. And you can see that the mean daily returns, they are dramatically higher for this model based on indicators. So the pure value, the difference between buy and hold, not necessarily is significant, particularly for model 18. But compound return that we calculated for SP500 was the highest for model with P25. And then there is a problem with Sharpe ratio that was also higher than P25 for model P25. And I want to emphasize that the way we calculate Sharpe, by definition, as far as I understand what is Sharpe, it's a ratio between excess return and risk. Now, when we calculate Sharpe for some mutual fund that has all 252 days a year money in the market, this calculation simply has a scaling square root of 252, obviously. But for strategies that get in the market and out of the market, we have to calculate the number of days where your capital is exposed to risk. and it is just 214 days during 4 years actually for the model that has only four indicators. So you actually basically keep your money in your pocket, and therefore we calculate Sharpe ratio by scaling risk with numbers where your capital was really exposed to market risk. But ironically, this period, 2009-2013, as you know, it was a well-pronounced bull market. And it's very difficult to beat bull market. Very difficult to beat buy and hold strategy during bull market. Because as soon as you get out of the market, you miss this momentum going up. And as a result, you can see that Sharpe ratio, for example, for model P5 that were less days in the market is lower than Sharpe ratio for model P25. And by the same token, compound return for this model was even lower than buy and hold. So while mean return was much higher, compound return was lower. And that's simply specific of the bull market. For industrials, the qualitative picture is about the same. So the most profitable in terms both of compound return and Sharpe is model with P less than 25%. Discretionary spending. That's actually this ETF actually probably was one of the most profitable investments if we talk about ETFs during this period. As a result, P5, while it was a Sharpe ratio for model P5, was lower still than for model P25, but higher than for buy and hold. And finally for finance performance of financial was not that obvious even during this bull market for various reasons. It's a heritage of gear market, so to speak. Buy and hold, Sharpe and compound return were very low. And in this particular case for financial, the model P5 was the best in all of those models. So that's in a nutshell raw results that we got. And now we can speculate a little bit why this happened, what happened, why we actually have excess returns on average, even though some surprises were negative. Obviously, some unemployment reports were bad during this period. Some housing starts were not that good as everyone expected, and so on. So why do we make these excess returns? Well, I don't have an answer. I have two speculations, and they are not really even mine. So the economists that studied this effects before us simply imply, not that they write it, but you can understand it between lines, so to speak, that these excess returns are a result of investor anxiety, if you wish, because investors hate uncertainty, and so they sell before announcement. It's speculation because it's very difficult to check. How they sell, we don't know. It's not necessarily the day before announcement. It may be week before announcement. And how they implement it, we don't know. But then what this thinking implies is that if after they sell into the announcement, and if announcement is not terribly bad, they return to the market the day after announcement. or maybe even during this peak. And as a result, we have excess returns. So excess returns do not necessarily mean jump in respect to some old value or trend, but in respect to selling that happens in the near prior to that's one speculation. And the second speculation that was discussed on CNBC in particular and in different sources is that during this period, during the bull period, 2009-2013, the contrarian thinking was very strong, which means that the bad news actually was the good news. Because what market was concerned mostly was the activist policy of Fed. What really Marx wants is cheap money. And so if there was a bad unemployment report, the thinking was that, okay, so the Fed won't tighten or cancel equity how does it call it? The policies that implemented by the Fed, which meant buying bonds. Quantitative easing. So for a while, quantitative easing was everything that the market wanted to continue, and then it stopped. What market still wanted was that the Federal Reserve won't raise the interest rate, and in that sense, every bad report meant that the policy will continue, and those who followed the market on a daily basis might notice that sometimes indeed bad unemployment reports didn't lead to market fall. And so this is another speculation why this happens. So this is one part of my presentation. And if you wish, I can answer some questions, because then there is another part that is directly related to this, but has another emphasis. Yes.
Based on in-day returns, but have you looked at or looked at the in-day returns?
What returns?
Intraday returns?
No, we did not. We didn't look at the intraday returns. All we deal with are daily prices. Okay, someone has the, okay.
Can you talk a little bit more about how you categorize news and how you got those 18 indicators from news?
Those are published, this is published information. For example, what percentage of interest, of unemployment increase or decrease happened, or factory orders. There is expected value that, there may be 60 to 70 economists polled by Bloomberg have expectation of particular level of factory starts or new home sales and so on. So there is this number that I mentioned, it's expected value, and then there is a hard number that publish it at 9:30 and you can find it on the web. Well, who was the first?
Okay.
Okay, who is allowed?
So many economists argue that macroeconomic shocks build into the equity premiums through factors, equity factors. Did you try to see that how the economic events like shocks affects the traditional Quantopian or bar factors, and then how these
What factors?
Palma French and bar?
No. No, we did not. Yeah, there was several questions. Okay.
Yeah, so I'll go next. So in your explanation or hypothesis as to why this is producing excess returns, you spoke to something about market psychology, which is essentially a regime. So I was wondering in terms of both why you would have picked the 2009 to 2014 regime and not looked further backwards associated with that, and then as you think about applying that to an out-of-sample, how do you think about the impacts of the regime on the analysis that you see?
Well, this work started in 2013 and hence we took, and we took, we started in 2009. Before, as I mentioned in the beginning, there was already a report that studied the effects of macroeconomic enhancement prior to 2009. And then, for technical reasons, we just got data starting with 2009. And we even wanted in the beginning to focus on one particular regime, which was bull market. We didn't go more than that. We just started doing something. And so for one thing, it was constraints with the market data we had, and for another, we wanted to, you know, to have sort of homogeneous market regime, which was a bull market. Now, regarding future, well, it's difficult to forecast future. But the problem with, and I guess this is, well, did you check 2014? Did you check 2015? No, and you know, when you talk about statistical analysis, there are all this, or I should say most of these announcements are done on a monthly basis. So you have 10, 12 points over the year. This doesn't make new statistics. You add to this 10 new points to 100 points we had before, maybe less, 60,000 points. So there will be a little bit different p-value, but you cannot make some sensational discovery based just on another few points. That's why we didn't pursue this, you know, studying this event. What I can say, that I have a feeling, and it's not statistically based or anything, that as much as I mentioned that in the past bad news was a good news, I have some concern that in our case the good news is also bad news. It's still bad news because markets sometimes go down even if the news is good, and this probably says something about changing psychology of the market. But I don't have a statistical backup on that. Okay. There was a question.
More or less the same question.
Okay. Yes.
So given that you don't use intraday data, I wonder whether you think what you're measuring is a pre-announcement effect or a post-announcement effect, or some combination of the two. And
What factors?
so
No.
I'm wondering whether you're measuring a pre-announcement effect or a post-announcement effect.
It's post-announcement because we get into the market on close the day before, and we get out on close of the day of the announcement. It's just one day in the market.
So for these announcements, the time of the announcement would vary across the different announcements. Right?
Most of them are published at 9 o'clock or something because it's Federal Reserve. It's, you know, it's most of macroeconomic announcements are compiled by government agencies. All right. Since I was asked to entertain you for another hour, or for an entire hour, I should say, let me continue a little bit. Another part of this conversation is, as I mentioned, all reports or academic reports in this area are based on surprise. And this is definition surprise is the difference between actual value of a macroeconomic indicator and expected value. And I don't like both of them. Now, unless you are so optimistic that you will start using this strategy with blind eyes and buy the day before and sell on the day, and you want maybe to do some forecasting and maybe implement more sophisticated strategy based on what surprises, positive or negative, you want to look what exactly surprises. These two values that constitute surprise, both actual announcement and expected value of the indicator, they have problems. First, when you say about actual strategy because it's look ahead bias, right? You have to get into the market the day before. So you cannot calculate surprise in advance. So that's one problem. Well, expected value is also a problem. You obviously can find this value on the Bloomberg, and it's a result of some averaging of 60 economies or something like that, and it's just one number. And I was always curious, who are these economists actually? Those are the guys who are employed by big buy-sell firms. And then the question is, do their firms, who really make the difference by trading large volumes, do they look at this single number, or they listen to their guy who they pay big money to estimate this number? And obviously, one particular economist working in all these Goldman Sachs and Morgan Stanley and so on may have his forecast, his expectation very different from the average over 60 other guys. So this number has very subjective nature, and that's why calculating surprises obviously has some merits, but for practitioners it may be not good enough, particularly with look-ahead bias. Instead of surprises that we put in the model like everybody else before us, we propose two different parameters. First is actual change. Actual change is the difference between new value of macroeconomic indicator and the former value, which is a very simple concept. Actual change doesn't have subjective nature, but it still has look-ahead bias. And then we introduced expected change, that actually is the difference between consensus and past value. This variable has still subjective nature, but it doesn't have look-ahead bias. So if you want to do some forecasting, probably you may want to think about expected change rather than surprise. And here are correlations between expected change and actual change, and you can see which tells us how accurate are these consensus estimates when we compare them with real hard values with new announcements. And you can see, say new home sales correlation is 0.26, which means that all the 60 economies of how many them are, they have very low accuracy for this forecast of new home sales. Some of them are quite accurate, for example, factory orders are, but housing starts are low, and the trade balance is low, and so on. Of course, all this information has limited accuracy. So what we did is that we included in our model, instead of surprise, these two new variables, actual changes and expected changes. And what we found as a result was that the same macroeconomic indicators were statistically significant regardless of whether we based our model on surprises or actual changes or expected changes. They are very close. So there's non-farm payrolls, housing starts, ISM manufacturing report, they're always important. Whatever metrics we use, whether it's surprises or actual change or expected change. And then what we did also, we tried to reproduce, those of you who have access to Bloomberg may find that there is a so-called Citigroup Economic Surprise Index. That is some reflection of also of macroeconomic indicators at current time. Unfortunately, Citigroup doesn't publish how they calculate their index using macroeconomic indicators. It's proprietary information. You can just look at it at Bloomberg terminal, and if you Google this Citigroup macroeconomic index, you may find various opinions about its usefulness. But in any way, what we want to do was that if they don't publish how they do it, maybe we implement our own macroeconomic surprise index, and everybody will like it or not like it, whatever. So we did so. So in that model that I showed before, we threw out all out regression terms and simply left a summation over all these indicators. And what we found was that surprises has great volatility, and therefore our results were not very good. You can compare that for returns, for example, the standard deviation was 1.3, and for surprises, the standard deviation was 5.5 actually, which means that surprises are 4 times more volatile than actually returns for S&P 500. And the least volatile was actual change, which reflects real numbers. So it was difficult to use straightforward summation to calculate this index. Somehow it stopped listening to me. Oh, probably. Okay, thank you. So we did some averaging. What we found was that the average results that filtered out some noise got us qualitative agreement between this empirical price for S&P 500 and the index is based on actual change and expected change. But the index based on surprises even couldn't catch the bear market of 2008. So the surprises were really bad in the sense that they were very noisy. And then what we did then, if you pay attention to the title of this slide, this was when we included in our index all 18 macroeconomic indicators. But then we left only 7 macroeconomic indexes with very low p-value, which means they were highly statistically significant. And you see even surprise-based index now showed us the peer market of 2008. So you can see these indexes actually qualitatively, they all have these hills and valleys as a real price. So these main indicators do reflect the price dynamics, at least qualitatively. And I emphasize qualitatively because you can see from these 2 axes the price during this period changed from about 100 to 190, but the indexes changed also from 100 to about 110, which means that indexes actually indeed define direction of price. But of course they are not responsible, they cannot grasp the momentum. So when there is a good news, supposedly price does move in the direction that surprise or a change of the index points at. But then there is a trading, of course. If there is a good announcement or good news and the market becomes optimistic, there is trading, of course, until the next announcement. And this momentum is not described by the index. And that's why the strengths of the bull market that existed during this time period, these indices cannot describe. But they can describe this price, the variation of direction of price quite well. And that's another takeaway from our results. This is just shows that when we go from 18 indicators to 7 statistical, the correlation between price of S&P 500 and the prices significantly increases. And that's what I wanted to tell you today. So that's all. We're done.
Thank you.
Thank you.